Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to the AICPA Town Hall Series. I'm Eric Askerson, one of your hosts for today. We've got another full show for you. We're going to be talking about some breaking news in Washington, D.C. I wouldn't necessarily call it breaking news, but just news from Washington, D.C. and what's going on with year-end legislative activities. We're then going to get into some technical updates with Lisa Simpson. She's back with us this week. And then we've got some really interesting discussions related to the FASB's Private Company Council, which Sue Coffey will be leading. And we've got the Private Company Council chair here with us, Candy Wright. And then we're going to get into a very hot topic for the profession, the CPA pipeline. And we're going to talk about some upcoming changes to the CPA exam, which we think will help these pipeline issues. And then we'll be closing with open forum and closing remarks. So here's the lineup for today. We've got a great group of leaders from the AICPA, as well as the chair of the PCC Council at FASB. So first off, I want to welcome Lauren Thingstag, who you all know. She's one of the leaders in our advocacy team. She's a director of Congressional and Political Affairs, and she has done a great job over the past couple of years, really kind of telling us what's going on in DC and also explaining how things work there. So welcome, Lauren.
Thanks, Eric. I'm glad to be here.
So Lauren, let's get right into it. We've been talking about a year-end package, bipartisan package coming together at year-end for the past couple of town halls. Ed Carl last week talked about some of the potential tax elements. I mean, it's always frustrating in many ways for the firms. They're busy, and then all of a sudden at year-end, they get this extender package. So why don't let's do our best at trying to forecast what's going to be in it, and also the potential for this deal. And I think you've put together a very interesting pyramid slide for us here.
Thank you. And yeah, you put it perfectly, Eric. I think our goal for this particular presentation is to make sure that CPAs are aware of what could come together in the tax space by the end of the year, so no one's caught flat-footed. So I am here to build the deal for everyone, so you can see how a deal could come together. And I don't want to, foreshadow too much, but I'm also going to explain how a deal could all come apart. But first, let's be optimistic. Here's how a deal could come together. Obviously, Congress is on recess. They're not coming back into session until mid-November. So detailed negotiations aren't happening right now on a year-end deal. If they do happen, they're going to happen in mid-November until mid-December. And I think it's important to understand, too, that every big deal that we've seen pass Congress in the past 12 months, I'm thinking infrastructure, the Chinese competitiveness bill, the Inflation Reduction Act, it starts off like this, really big, and then it shrinks over time. So I'm going to build the bigger deal for you, but know that it could obviously shrink over time because that's the theme of the year legislatively. So when I think about a one-year deal that cobbles together the mishmash of leftover trade and tax and healthcare provisions and priorities that didn't ride on those larger packages, I think of this one-dimensional pyramid. And I've colored different provisions, blue, red, or purple, depending on whether the item in question is a Democratic priority, a Republican priority, or a bipartisan priority. And the reality is that this entire package really could be purple. This whole pyramid could be colored purple. But as the parties start to negotiate over what could end up in a year-end deal, they're splitting hairs, taking sides, and some of the bipartisan or purple priorities are going to be recast or reframed as partisan issues. But I like the pyramid because right now it helps illustrate that everybody wants something, right? Which is always a really good sign that a deal can come together. So if you look at the base of the pyramid, we've got three issues that I think are the glue that holds a year-end deal together. And the first is a fiscal year 2023 appropriations package. The continuing resolution, which keeps the government lights on, expires in mid-December. So lawmakers have to come back and pass either an appropriations package that funds the government until next October, or pass another short-term continuing resolution. Most lawmakers would prefer to do an appropriations package to a continuing resolution because, one, they don't want to have to keep taking votes on funding the government. That's no fun. You don't like to explain that necessarily to constituents back home. And two, its appropriations packages offer more long-term certainty to folks in your district who care about that. So there's a lot of interest in getting an appropriations package done in mid-December. The second piece that would be, like an item that glues a package together is something we've mentioned before on town halls, and this is legislation aimed at growing Americans' retirement savings. And so I know that there are CPAs that care about this. This is really important for CPAs and their client tax planning if it passes. And there is a lot of bipartisan interest around getting something done. The House passed a retirement bill back in March with over 400 votes, I think. There are 2 Senate committees that have their own retirement bills. And if you hold all 3 bills up side by side, there are so many overlapping provisions, which again is a great sign that something could get done in this space. And the last issue that I think could glue a package together, and I know there are folks on this town hall who have talked about this and are aware of this, is the potential need for a Section 174 research and development amortization fix. I think we all know that TCJA amended this section of the tax code to no longer allow the immediate expensing of research and experimental expenditures beginning in January of this year. Instead, those expenses had to be capitalized and amortized over 5 years. And so this is a corporate tax provision that a lot of bipartisan lawmakers are interested in fixing. And by fixing, I mean take this section of the code back to its pre-TCJA schedule and offer retroactive relief to businesses in 2022. So if you're a CPA working with someone in the manufacturing space, in the pharmaceutical space, this is something that the people on the Hill are hearing about and care about. And then we get to the middle of the pyramid. And so if a deal starts to come together, there are 3 items I think could be pulled along into a larger package. This is LIFO relief for auto dealers. And we've talked about this. We support this. It's a little bit niche, right? It only impacts auto dealers. But the co-sponsor numbers are huge on the bills in the House and the Senate, which tells you never underestimate the power of the auto dealer industry. They can throw their weight around on the Hill. Tax extenders, a few of these got cleaned up in the Inflation Reduction Act, but there are still some hanging over. Typically, those get swept up in a year-end package. And then there's a Democratic trade priority about reauthorizing a program that gives American workers who've lost jobs due to foreign competition some income support and job retraining. And that program just needs to be reauthorized. Typically, members of Congress do it on a bipartisan basis because everyone has a worker usually in their district who's impacted. And so I think that could be something that gets swept up in a larger deal. And then we start to get into those little provisions that, will probably be kicked down the road or ignored, even if a bigger package comes together, because either they have strong opposition within Congress or they're just too costly. I think members would love to see something get done at the top of the pyramid on syndicated conservation easement reform. But Senator Sinema, who we've talked about as one of those key swing votes in the Senate, doesn't like the legislation as it stands, wants to see more debate before it passes. So the only reason I think it would be included as a year-end deal is because the reform raises money. And if there is a struggle to pay for this package, that could get slipped in at the last minute, even over Senator Sinema's opposition or qualms about it. There's a corporate tax provision that feels really niche that I think Republicans are particularly interested in fixing. This is about the business interest expense deductions and restoring the expense deduction back to, I think it's a 2021 limit, which limited businesses' interest expense deductions to 30% of earnings before interest, tax, depreciation, and amortization. There's not a lot of bipartisan support for this, and Democrats are going to be really hesitant to support a corporate tax fix if they don't get what they really want, and this is the third item, if they don't get something on the child tax credit. So Democrats are rallying around the idea that they need an extension of last year's enhanced child tax credit. They feel like it lifted a lot of kids out of poverty in 2021, and they are openly toying or talking about the idea that they're not going to let any corporate tax priorities be fixed unless some kind of enhanced child tax credit is passed. But if you compare the cost of doing something on the child tax credit to the cost of fixing some of the corporate tax priorities, the child tax credit fix costs hundreds of billions of dollars. And the corporate tax priorities don't cost as much. So that may not feel like a fair trade to Republicans.
Hey, Lauren, we got a couple questions coming in here. So just one is just on process. Someone's asking, is there any way they could use reconciliation to kind of get this through? That's one. And I'll just give you the other one as well. Just saying, when we look, I mean, this is a pretty big list, and there's been a lot of legislation. I mean, that was with the Inflation Reduction Act that just passed for $700 billion. Now you've got this coming at year end. So a lot is going on. But when you look at this list here, are the members kind of communicating with us on what they think might add the most complexity to their year end? Do we have any kind of reading on that? So one process, one on kind of complexity.
Yeah, on the process question, and I love a good reconciliation question. So thank you to whoever submitted that. No, they can't. Technically, they could. You're allowed to do up to 3 reconciliation bills a year, but you can only do one each year that has a tax title, and they just did that with the Inflation Reduction Act. So it's also way too much work and floor time to get a reconciliation bill through. This would this have to be a cooperative agreement. Right. Yeah. And in terms of are you asking, Eric, whether members of Congress are communicating?
No, our members. They're just our tax team there, the tax technical committee. When they look at this list, is there one here on this list that's giving a lot of concern, just kind of from a standpoint of implementing this and supporting this with their clients?
So we have, with the tax team, the AICPA tax team has talked openly about the need for the LIFO relief. We are obviously supportive of tax extenders being fixed. We have jumped into the FY 2023 appropriations debate because we care about the IRS remaining funded in the event of a shutdown. We've had behind the scenes discussions on syndicated conservation needs reform, but there's nothing on here, if I'm looking at the list, that I think would be a red flag for our tax team. It's all pretty standard stuff.
Got it. Well, this next questions that are coming kind of is a good segue. Everyone's asking about, well, what impact will the elections have? I mean, the title here, the optimistic case. So I guess there's a pessimistic case out there. So what are the chances of none of this happening, and what does November, the elections mean, and then moving us to year end in early 2023?
Yeah, I feel so badly because I just built the deal.
Right.
And I gave everyone the warm and fuzzies on how a deal could come together. And now I'm here to tell you it could all collapse.
There you go. So this is the 60, because it's got to be 60 votes in the Senate. So this is tug of wars are going to begin.
Yeah, you need the 60 in the Senate because you can't use reconciliation for this. And there are 4 things that I think are going to prevent a deal from forming or could prevent a deal from coming together. And the first is it's pretty simple. It's feelings, Eric, right? Like, lawmakers are human, just like you and me. And emotions on both sides of the aisle are still a little raw after passage of the Inflation Reduction Act. I think you just saw Republicans deny Senator Manchin his opportunity to pass his permitting reform legislation, which was the sidecar deal he cut with Majority Leader Schumer to get his vote on the Inflation Reduction Act. So there's going to be a little bit of what I'll call revenge politics for a while. And then the question is, how are lawmakers going to feel about bipartisan cooperation after the election, right? Are they going to be in a mood to compromise? And whether they're in a mood to compromise or not depends on the result of the election. And then it's like, well, do we know the results of the election on November 9th? And we may not, which is, always a surprise to some folks. There are a few tight races in the Senate. Georgia is one of them. In Georgia, if no candidate wins an outright majority of the vote, there's a runoff between the top 2 finishers. And that doesn't take place until December 6th. So imagine not having negotiations on a year-end package until December 6th. And you've got 10 days left to figure out whether you want to do a continuing resolution or an appropriations bill. Obviously, what do the new majorities look like? What are their incentives? What is the ideological makeup of each caucus? Are we going to have people who are really interested in compromise, or are we going to have members who, are incentivized not to compromise because of their constituencies or particular interests? And then the last thing I have to point out is we cannot underestimate the Democratic desire to expand the child tax credit. They are really coalescing around this as a key priority. And if they don't get this in a year-end package, they could put their hands up and walk away and say, you know what, we did a great job this year. We passed infrastructure, we passed the Inflation Reduction Act. Let's focus on those. So I'm sorry to be the Debbie Downer. I told you how the deal would come together, and then I just explained how it could all fall apart.
Well, I think we've all been watching the last couple of years, and we know that, there's no sure predictions in Washington, D.C. So, but I think the town hall audience appreciates how you review the process, review, what's most likely, and also give both sides of the story. As I say, we're going to lose you to one of the Sunday morning shows someday. So thanks for all of your leadership, Lauren and Mark and team there and out of the DC office. It's been a very busy year, and we look forward to continuing this discussion with you. So thanks for today.
Thank you, Eric.
So now we're going to bring up Lisa Simpson. Lisa, it's great to see you.
Hey, Eric. Thanks for the opportunity. I know everyone's really busy. We're just a few days away from an October 17 deadline for lots of you all. So let's jump into some technical updates. I was going to try to take it easy on you all, but unfortunately I have a couple new acronyms to introduce you to. So let's get started. Sticking with kind of the DC update, we have a new rule that came out of the FinCEN. So what is FinCEN? That is the Financial Crimes Enforcement Network. So there's your first new acronym. If you're not familiar with that one, you might have heard it as it relates to the FBAR filings. So on September 29th, they released a new rule. It's about 330 pages, so some good bedtime reading for you. But they also released a fact sheet, and we're taking a look at that. We'll be digging in and giving some recommendations, but I just wanted to go ahead and bring it to your attention, get it on your radar. And we're having a little bit of technical difficulty, but there's the slide. So basically the purpose of this is to create a beneficial ownership information reporting database. And it's going to be accessed by federal and state law enforcement as needed. So why is that? So basically the goal is to help prevent and combat corruption, money laundering, shell companies that just flow through illicit money without a good trail. And here's the kicker. It's going to apply to what's called reporting companies. That's about 32 million entities that we've estimated. And you can see some of the details there. It's going to, this business beneficial ownership information is going to apply to many of your clients or your company. There are some exceptions, and we'll be digging into those exceptions in future town halls. We'll be providing resources. So don't worry about it just yet, but I wanted to have it on your radar because it has been in the news. Your clients might be asking about it. And basically, it's going to require what is seemingly some simple information: names, birth dates, addresses, an identifying number, and supporting documentation for these reporting companies. It is not effective until January 1, 2024, but you don't file the report until that end of that year. So again, we've got time, but wanted to get it out there. Basically, this is a shift away from financial institutions having to report this information to FinCEN under the Bank Secrecy Act. we're when we first looked at the rule, we were concerned about the scope and the burden, because there are not just one filing, but if there's a change in ownership, then there's another filing that has to be done within 30 days of that change. So again, we'll keep our eye on it for you, but there's 2 new acronyms for you today. And then to some other not so great news. Our thoughts and our hearts are with all of the people who've been impacted by natural disasters across the country. Recently, it's been Fiona, Ian, and then Alaska had what's called either typhoons or storm flooding and landslides. So the IRS has come out and issued for federal filings an extended deadline for those filings. So now impacted victims have until February 15, 2023. There is a question in the Q&A that just came in. Does that extend to FBAR filings? The FinCEN just announced today that yes, FBAR filings for impacted victims of these disasters are able to take an extension deadline until February 15. So hot off the presses for you there. An interesting tidbit that I personally wasn't aware of, but so I wanted to make sure I called it out to you, was that federal disaster relief is available to a tax filer if their tax preparer was a victim of one of these disasters as well. So just I've given you a link to that, and you can dig in if that might be applicable for you. We have some disaster planning resources available. There are some recovery tools that are open to you. You can share those with your clients. And then an important thing that I wanted to make sure you all knew about is that the AICPA Benevolent Fund is available to AICPA members who have been impacted not only by these disasters, but who might have health issues or something like that. So it is a resource available for you. I know that we have so many of our members who live in these impacted areas, and I wanted to make sure that you know about that benefit fund that you could apply for. So we talked about filing deadlines. Now let's talk about employee retention credits. I have great news. We have been talking to you the last couple of weeks about a client-facing resource that our tax section was working on, and that is now available to you. It is to help you work with your clients to dispel some of those myths that they're being fed by some aggressive ERC marketing. We've got it uploaded for you in the materials for today, and I've also given you the link. I love it because it is pure, straight up, it is fact or it is fiction. And it gives you some of the nuances around some of those answers. So it's going to talk about shutdown orders, revenue decline, supply chain disruption, stay-at-home orders, and whether or not those just magically qualify you for the employee retention credit. So great resource for you. I do hope you'll all take advantage of that. And I do hope that it helps with some of those client questions that I know you're getting. Just some other tax items, because got to bring up another favorite topic, K2, K3. As you'll recall from our September 6th conversation with Ed Carl, we've been advocating for a lot more clarity and a simplicity around these filings that relate to reporting international income tax items for pass-through entities. So the IRS just released draft forms, and not all hope is lost. If you looked at them and you said, I don't see much change, that's true. There was not much change on the face of the forms, but a lot of what we've been advocating for and what we're still advocating for is going to be fleshed out in those instructions to the returns. So we are not letting our foot off the gas. We're continuing to make our concerns known to the IRS, and Ed Carl has an upcoming meeting in November to continue to press for clarity, simplicity, narrowing the definition of who needs to file these returns. There was a lot of interest in this R&D credit that some news came about just recently. So I wanted to make sure that you knew about it. Basically, there's a transition period that has been extended for another year, which we've been advocating for, around this new rule that only gives 45 days to perfect a refund claim. So again, good news, we've gotten a 1-year extension on that transition period rule. And let's see what else we got. We got single audit updates. And this again relates to some of the natural disasters that we've been facing over the last couple of weeks. So the Governmental Audit Quality Center has been working really hard with OMB, HUD, HHS to try to get some relief for filers in these impacted areas. So on September 27, we got a 6-month extension for recipients in Puerto Rico who were impacted by Hurricane Fiona. And they now have until, they have a 6-month extension to file their reports. So if their report was due between September 18 and December 31, back that up 6 months. We're asking for additional relief on the for-profit filers who had submissions due to try to get that 6 months extended as well. We'll keep you posted on that as soon as we hear anything. And then we've also asked for the same relief for Ian and our situation in Alaska. So again, stay tuned. If these impact your clients, just know that we'll get the news out as soon as we can. All right, slight change in topics. I want to switch over to the audit side for just a minute. We've been talking over the past 6-8 months about the new quality management standards that were issued back in the spring, summer. So again, don't panic. The effective date is not until 2025, but it's really important that if you're in this space, so if you're doing services under SAS, SSAEs, or SARS, then these are going to apply to you. We have a roundtable that you can register for to start getting some of your questions answered.
Well, Lisa, that was quite a wide update on a number of topics. So thanks for putting that all together, and thanks for PCPS with that resource on the employee retention credits. And here, just on quality management, I know this is something we're going to be talking more about, and maybe tell people again, the key driver of why this is being done.
Well, quality is the foundation of everything that we do, especially in these assurance, audit and assurance areas. So this is just an effort to comply with international regulations, but also just to make sure that our standards make sense and that they're in tune with the times. Risk management is a huge component of it. So lots of great resources that we'll be developing.
Well, Sue's coming up next, and she's got a big role in quality management. I know in some ways they're trying to make this, even as they improve it, to make it simpler for firms as well. So we'll be working on more communication related to this hot topic. So thanks, Lisa. And we're now going to move to this discussion with FASB's Private Company Council Chair. And we've got Sue Coffey, who you all know, the CEO of Public Accounting for the AICPA and SEMA. So welcome, Sue.
Thanks, Eric. I'm so happy to be here. And I'd like to, if we could, bring up Candy Wright. And as Candy is coming up, this session is about accounting standards. And Candy is the chair of the Private Company Council, or PCC, and we'll get into what that is in a minute. But Candy also has a day job that I think is really important that you know about. She's also a senior partner at Postal Wait in Netterville in Louisiana. And so in her role as the chair of PCC, she is very acutely aware of the difficulty in implementing accounting standards because her firm services small and mid-sized clients. So she has obviously firsthand knowledge of some of the challenges firms are having. And so welcome, Candy. Thank you for coming. I'm thrilled that you could be with us today.
Yeah, thanks for having me.
So I'd like to just kind of dive in really quickly and I guess say that I am almost positive there is at least one person in the audience who has no idea what PCC is, how long it's been around, why it was established, what it does. And it is a really important group for the profession. And I thought we'd start out by maybe you could give us a quick rundown of kind of like the when, where, what, and why of PCC.
Sure, thanks. So this conversation relating to private company financial statements and financial statement users has been around for a really, really long time, but it got started in earnest, I think, talking about it in 2006 when the FASB created the PCF, the Private Company Financial Reporting Committee. And as that committee made progress and as conversations continued to happen, in 2011, there was a blue ribbon panel that was created to really talk about what are the needs and what can be the possible solutions to getting the private company's voice elevated and really considered in standard setting. And so as that evolved, in May of 2012, the FASB, or the FAF actually, the Financial Accounting Foundation, which appoints the FASB board members and also appoints the PCC, established the Private Company Council. And when it did that, it appointed the PCC as the primary advisory body to the FASB on private company matters for accounting. It also includes providing input on their current agenda, but also looking back in the existing gap and seeing if maybe there are practical expedients or alternatives that may need to be considered with respect to existing things that may be complex for private companies and maybe not providing a lot of value. So there's a two-part to what our goal is from the PCC.
So it started out really because, small businesses and small firms were somewhat frustrated by some of the standards. I think that's what I heard you say. And because FASB tends to focus on the larger public companies, but there was a need for that private company voice, but in a more formal manner. And I know that PCC jumped in very quickly when it was established. We were very excited about this. And as you said, we wanted to take a look back and look forward. And there's been some great accomplishments. And so I'm wondering if maybe you can pick one or two that you think have been particularly impactful and maybe tell us why.
Yes. So I guess just also a little context. The PCC is made up of right now 11 members, and they come from three primary different private company stakeholders, practitioners like myself, also preparers, CFOs, and users, so bankers, sureties. We even have someone from academia on the PCC now. So when these standards are being discussed, we're discussing it from all different angles, and we all have different points of view, and we have to come to some sort of consensus as to what might make the most sense from the private company stakeholder perspective. And one of the primary ones that everybody agreed on, there wasn't a lot of disagreement on that one, was the amortization of goodwill. The bankers didn't use it. The users didn't have, the other users didn't have much need for it. The preparers said it's just a number on our financial statements that we don't really get any value from. So the amortization of goodwill, I think, was a really monumental step that the PCC took, and the FASB endorsed. Everything that the PCC does must be endorsed by the FASB. So we can't just set standards on our own. It must be endorsed by the FASB. The other item that I think we had real involvement with, it came out as a FASB standard because sometimes the FASB can get it done quicker than we can. We meet 4 times a year. And so sometimes it's better for us to recommend that the FASB put it on their technical agenda than the PCC try to keep it on ours because we don't meet as often. But the other one that I would point out and that I'm really proud of and excited about was the ASU 2018-17, the VIE private company alternative for commonly controlled entities. The fact that you don't have to navigate that guidance to find out if you have a VIE and whether or not it needs to be consolidated, if you have an arrangement between commonly controlled entities. So that was huge. I think that one in particular took a lot of cost out of the system for practitioners and for preparers.
So I noticed on the slide here that you've got the PCC inspired FASB simplification initiative. which I think is really cool. And just kind of having, heard some of the dialogue at various points over the years about, simplicity and clarity. It's really nice to see that some of what the PCC is recommending to the FASB also impacts the work they're doing for public companies.
That's right. That's correct. And the FASB embarked on this simplification initiative, and it was inspired by the work that the PCC did. And there was a common term or phrase that started to be used at the FASB, and you heard it all the time when you were in meetings. It was necessary complexity and unnecessary complexity. If a transaction is complex, guess what? The accounting is going to be as well. And there's not a lot that we can do about that. But it's the unnecessary complexity that the FASB was focusing on with this simplification initiative. And I think it accomplished a lot of good things. There were about more than 15 ASUs that came out of this initiative.
So a lot of great stuff already done. Are there any issues you wish may have been addressed differently? And maybe that really gets to the current agenda. I know you had a meeting a couple of weeks ago, and that agenda was pretty meaty. What are you talking about around the table right now?
Yes. So we are actively working with the FASB on addressing leases between common controlled entities. Again, it's that common control, and that's that really doesn't exist in the public company world, which is why it lands on the private company space. So we are working with the FASB to try to help guide them to hopefully a practical expedient to 842 that will give some additional guidance and a little bit of relief from some of the complexity that might surround trying to analyze leases under common controlled entities with respect to whether or not those leases are legally enforceable. And I know that the CPEA has to say about this, and a lot of speeches to raise this issue. And so they should be given credit for this as well, trying to make everyone aware of this. One of the challenges that we face is sometimes private companies don't start applying standards until later in the cycle. And we don't really understand how big the issue is until private companies start trying to implement some of these standards for their clients, or the private companies do it themselves. And so the voices get loud whenever that happens, and that's when we can really have an impact and really make a change and a difference at the FASB level.
So you want voices to be loud. You want feedback from the community, so you can bring that to the FASB table through PCC, this more formal structure.
We do. It came out loud and clear at the AICPA Engage Town Hall that the FASB had at the Town Hall meeting. And I will tell you, the FASB board members were thrilled. And now some of the comments were, a little harsh and tough sometimes, but they were thrilled to have the feedback, to understand that, okay, now the private companies are really getting into this, and let's see where we need to make some changes. And so there was it wasn't that they were upset for the feedback. They welcomed the feedback. They were encouraged by it.
Yeah, so a couple of things. We have a link here on this slide that the audience can use. If you have perspective that you would like to share with Candy and with us on accounting standards, you can send it to that box. It's in the right-hand corner. The other thing Candy mentioned, CPEA, that's the Center for Plain English Accounting. And it is essentially like a national office for small firms. And they do these amazing reports in plain English. And there is one on leases that I believe are in your materials. And then the other thing I wanted to remind you of is that several years ago, as a result of the complexity in financial reporting, we also developed a financial reporting framework for small to mid-size entities as an alternative to GAAP. It is a special framework, or I'm in my 50s, so we called it AICPA. And like the cash basis of accounting, but it may actually be more relevant to users of smaller entities' financial statements. And there's a resource in the materials that you can link to as well. And then we'll send that link in the follow-up newsletter. So those are just two things that I wanted to mention as well. So Candy, sounds like there's been a lot of success, certainly more to go, very relevant and important to the profession. And I know I'm very appreciative of the work that you and the entire PCC do in carrying that message to the FASB table. So I want to thank you not just for being here, but for spending your time on this and your commitment to the profession.
Well, thank you, Sue. I enjoy it, and I have seen a lot of evolution since we started this. Comments are well, and actually they're proactive now in seeing what could this mean for the private companies, and I think that's huge leaps and bounds steps forward.
Agreed. Thank you. So I'd like to bring on Mike Decker as our next guest. Mike, there you are. Okay, welcome, Mike, and thanks for joining us. Mike is the association's vice president of CPA pipeline and the CPA exam, and we wanted to bring Mike in to speak with us since we know that in addition to dealing with IRS and tax complexity, talent recruitment and retention are numbers 1, 2, and 3 for every size firm. There is not a day that goes by where I don't hear from multiple firms on their struggles of finding talent and asking what we as an organization are doing to help. So Mike, welcome. I know you've done a lot of research on the talent pipeline, and maybe if you could start out by talking to us about some of the factors that are contributing to our inability to find talent.
Sure. Thanks, Sue. And this is my first town hall, so I'm glad to be here. So yeah, we've done numerous studies over the years, and this is I think a really strong list of all the things impacting and constricting that pipeline. Tighter immigration policies, so we've got less international students studying accounting in U.S. universities. That has limiting the pipeline. We are seeing declining college enrollment, not only due to declining birth rates, but just less students in college, and COVID clearly did not help that. Between 2019 and 2021, we saw over 1 million students drop out of the pipeline and drop out of university. So that was a drop of 6.6%. And where we thought students would go to community college in that same time frame, community college enrollment dropped 13%, over 700,000 students in that same time frame. So you've got less students in college, and why is that? One is increasing college costs. So students are saying, I can't afford it. It's too expensive. It takes too long. And in some cases, the college costs have exceeded many people's ability or willingness to pay for a college education. The Hechinger report just put out for the first time ever, over 50% of teenagers are open to something other than a 4-year degree. So we're going to see, I think, a constricted college pipeline for some time. You're also seeing a different generation of students. They have different perspectives on education. They have a different perspective around a desire for a more immediate return on investment. And clearly they're thinking more about work life and meaning. The other challenge, and I know a lot of the firms, whether it's a big 4 major firm or small firm, they're trying to address the profession's reputation. They're trying to make it more attractive, address the crazy hours and the burnout, and diversity challenges where students don't see themselves as CPAs and as a public accounting. So I think we've got to just change our what we're saying about public accounting and work together.
So Mike, we know these demographic issues, though, exist for every profession. This is not unique to the accounting profession. And we are a profession, obviously, and with a profession comes education requirements as well as exam requirements. And we need to address the challenges. We need to adapt. So what are some of the things that the association's doing to help the profession operate in this changing and challenging environment?
Yeah, great point. And the other thing, and you sort of mentioned all the hurdles that we have about being a educated profession and a license. I don't know that there's any one hurdle that's stopping students more than any others. There's a number of hurdles, and in some cases you need them to protect the public. And it's the reason why, we're licensed in the work that we do. So the AICPA has taken a leadership role. We've pulled together these key stakeholders in a summit stakeholder group. We've brought in representatives from state societies, firms of various sizes, NASBA state boards, and then from academia and the universities. So, real quick at the highest level, what the AICPA is doing, pulling this group together. We are exploring, internships. We're working together with NASBA to develop a program to help students get to 150. We're brainstorming potential solutions. We're going to be doing extensive outreach, and we'll have lots of opportunities for feedback, from many of our stakeholders. Clearly, evolution, and I'll talk about that in a second, the changing to the exam is going to cause disruption in the pipeline, but we think it's a better exam. We've removed some content. Again, I'll talk about that, but I think it's a better exam that's has adapted to the changing profession. We are working very hard with ensuring that accounting is recognized as part of the technology within STEM, both at the national level, and the state societies are helping with that. Center for Audit Quality has done a great job with advocating for accounting with their Accounting Plus initiative. So a lot of different groups are doing a lot of different things. The state societies we see, because they're in each of the different states, I think they've got the ability to pull the different groups together, the high schools, the universities, firms, students, and they know their local area probably better than anybody. So we're arming them with the information they need. You heard Lisa, and I think she's coming back to do some, the firm of choice. We do know the research has shown that firm demand is the number one driver for someone to want to be a CPA. So, providing support, payment, rewarding them and sort of coaching them and mentoring kids through the CPA journey is really a big driver. NASBA is doing a lot as well. They have the candidate information, so where they can make some of the rules and application processes more common, and we're calling them the shepherds of the candidates, if you will. And so they're providing reminders to the candidates. You've got an open eligibility, why you haven't you scheduled, please go ahead and schedule before something, before life gets in the way. And then lastly, we know that the colleges and universities, and even at the high school level, can do a lot to drive the excitement that can be, viewed as accounting and CPA. It can be an exciting profession. I think we've just got to do a better job of promoting it.
So, Mike, before we get into, because I want to go a little bit deeper into the CPA exam, because there are going to be some changes here, but I am sure that there are a lot of questions coming in about the 150-hour requirement, because I've been talking to a lot of practitioners over the last many months about that and the benefit of it and the challenges that it faces. And we talked about it as a hurdle, and it is one of many hurdles that individuals coming into our profession, and yes, it is a profession, need to tackle. And there are a couple of things I wanted to raise here, because there are a lot of factors as to why students don't seek CPA licensure. And absolutely, no question, the 150 hours is one of them. But I always like to put that into perspective, because, I know a lot of practitioners are concerned that it's the primary factor, and actually surveys show that it's not even really close. Yeah, it is one. I absolutely acknowledge that. But it's interesting when you look at the top 5 reasons, and I think they're actually very manageable, and just changing a few things could help significantly. And so the first one is workload. They can't find time to study. And so this can be fixed by just recognizing this with your professionals who are working with you that still are on the CPA, path, and working with them just to find the time. The second one is personal time commitments. And that one's a bit tougher to fix, because that gets to, family and caring for people and work-life balance, but it's related to the first one. So again, helping the individual find the time and giving them the motivation to study, I think is something that is very fixable. The third is interesting, and we're going to get into the CPA exam because I think CPA evolution and the new exam is going to help with this, is fear of failure. And Mike, I'm going to ask you about that when we get to the next question. The fourth is navigating the exam application, and shame on us if the exam application is difficult to navigate. We need to fix that, and I know we've been working with NAS on that. And then the fifth is just it's the exam is hard. It's a high stakes exam. And there's cost to the exam. And again, that's something that firms can help with. Exam, prep review courses, giving them, the funding up front for that, paying for them to sit for the exam. I know a lot of firms do that. But anyway, I felt like I should go through the top 5 because 150 doesn't even fall into that category. But having said that, it is really important that we address it. And Mike mentioned the fact that we are looking at creative ways for students to accomplish that in a very cost-effective way, involving expanded internship credit hours or work study that would account for like those extra 30 credit hours. So there are a lot of things we're working on, and hopefully we'll have solutions over the next couple of months. So, Mike, I'm sorry I hijacked that a bit, but I knew the question would come up. And I would like to, though, dive a bit deeper into the changes in the CPA exam because they're coming up quickly and it's actually really exciting. So could you tell us a little bit about that?
Sure. It is exciting. We'll be ready. We're targeted to launch in January of 24. The good news is the foundation will remain the same, with the core being financial accounting, tax, reg, and audit. I think the benefit is candidates will be able to sit for a discipline in an area that either they're most passionate about or most knowledgeable. So tax compliance and planning, business analysis and reporting, and information systems and controls. So you can see the color coded boxes there, allowing for different a little bit of deeper knowledge and more broader knowledge in specific areas. So instead of 4 general sections, we've got the foundation of 3 sections within the core. And then again, candidates, we've already heard from some candidates, I'd rather take a deeper section in an area that I'm either passionate about or that I've got an internship in. So we're excited about that. I promise it won't be harder. It'll just be different, and we're working with the review course providers and academia to get everybody ready.
Yeah, and we actually think that this is going to widen the funnel a bit at the beginning because of how a student, that middle is all about the core, foundational, we all would agree that every CPA needs to know, but then, being able to kind of focus on an area that you're most interested in. And then, of course, the CPA is a CPA. So it doesn't matter which discipline you choose. If you end up in tax and then you want to move to audit, just like today, you'd be able to do that with training and supervision and whatnot.
Yep, absolutely.
Yeah. And Mike, we are doing a lot to prepare the students around for this, correct?
Yep. Review course providers, and we've already been working with academia with the model curriculum and the like. So they'll be ready. And we've removed some content from the exam. So always looking to remove stuff that we no longer need to assess.
Right. To provide the relevance.
That's right.
And Mike, you mentioned firms earlier, and that firms are obviously a key stakeholder and can have the greatest impact. I'd like to bring back Lisa Simpson to talk about what firms can be doing right now to help change the dynamic.
Thank you, Sue. And this is something I'm pretty passionate about. I hear from firms all the time about what they're doing that works. And so these are some of the things that are actually working. And I think the first one is start earlier. I always compare it back to basketball recruiting. I'm from Kentucky originally. We know how to get them young, get them early. So you got to get in there young and get in there early and start generating the interest in accounting as a career. There was a comment in the Q&A about what an amazing career can be, a career in accounting can be, and I absolutely believe that. But you have to message it, and you have to get their interest and pique their interest early, and then support them throughout their journey. It might take giving them a paid internship in high school rather than waiting until college, but just starting to support them earlier in their academic career would be good. We talked about supporting candidates. We've got a whole toolkit that gives you some of the best practices that we found by interviewing firms, recruiting differently. So looking at different college campuses than you're normally recruiting from to try to increase that diversity. And diversity comes in all colors, all abilities. So don't just think about diversity as an ethnicity. There's so many factors around it. There are other things that we can talk about, but I'll quickly hit on becoming an employer of choice that Sue referenced. We've made great strides, I think, in the past couple of years of offering more competitive salaries for the profession. Now we have to work on things like work-life balance and talking about how the work that we do has meaning and is impactful, not just to our clients, but to the society as a whole. We could spend 3 hours on this. I get a little excited. So we'll come back and talk about it again, but got some great resources for you to access.
Hey, Lisa, I'll just add one thing, and you were with me last week when we held the executive roundtable. But what I hear from a lot of firms that are close to, building out some of these new capabilities, that it's very energizing to their staff, and it's actually another way to really retain and recruit and allow them to work on some of the more strategic elements of their work with the client as you leverage technology to automate some of the routine tasks. So that's, I know there's so many things up there, but I just thought I would throw that could be a six item.
That's part of my employer of choice, is giving different opportunities and, crafting a one-to-one career path rather than just, here's step associate, senior manager, et cetera. So new opportunities and different career paths.
Yeah. And Lisa, I would say it's a great story to tell, right? You talk about going into the high schools and getting to them early. Think about the impact that the profession has had on our economy, on business over the last 3 years. That's an amazing story to talk about your journey as you go and talk to these young students about how exciting our profession is.
Yeah.
Well said, Sue. I mean, absolutely. I mean, it was a defining era, defining moment for all the firms helping their clients go through the business relief and the shutdown and the reemergence of their business activity. So now we only got a couple minutes here. We got a lot of great feedback today. So I always like to thank, one of these town halls are two-way. We try to bring you the latest information, talk about strategies, bring you key updates like we did from the FASB's PCC chair, Candy Wright. But we also welcome your input. And Candy, they give us input related to what's going on at FASB. And Sue, we got a lot of input related to the pipeline and items like 150 hours. So one question, Lisa, I'll ask you, and I don't know if you've got a question that you noticed, but it was related to the I don't have it right here in front of me, but the IRS notice on the hurricane relief, and there was just a question about does it apply to everybody in the state of Florida?
Gosh, I'd have to go back and dig into the details. I really don't know off the top of my head.
Okay, the way it's worded, it seems to me, Lisa, you don't have everything memorized. It seemed to me that it does. So we'll put that in the follow-up newsletter. We don't want to create any confusion, but it does appear that if you're in the state of Florida, you're eligible for that relief. Yeah. Anything else, Lisa, that you'd like to bring up from the town hall questions?
No, I do just want to remind everyone to download those resources that are in the materials today. I think they'll be great. And if there's interest in a further discussion on FRF for SMEs, I'm game.
Okay. Well, thank you again, Candy. Thanks, Sue. Thanks, Mike. And I guess Lisa and I will take you through these final slides here. So we try to always give you an in summary slide. We hope you do leverage these slides with your clients and with your firms. Here's the recent town hall sessions. And one thing that we're trying to do in the newsletters that we publish after the town hall is to break up the segments. So there might be one segment that you like, you can share that. So we're always trying to make this information as useful and as efficient as possible for you. And we've got a great team that is supporting us behind the scenes here, answering the questions and putting a lot of these materials together. So Lisa, we're going to be coming live to them. We're always live. We'll be live from AICPA Council on October 20th. And we'll have both.
I'm looking forward to that one.
Yeah, well, Barry and Mark joining us. And we look forward to we'll obviously share with you discussions that are coming from the governing body of council, and also what we do every couple of weeks, just bringing the latest information and news. So here's the upcoming episodes, October 20th and November 3rd. So Lisa, I'll let you sign off. You've got any wishes with the October 15th deadline coming up?
Yeah, but I was just going to say, I know it's October 17. I see some of you are telling your clients it's still the 15th. I like it. But thank you for hanging in with us today. We know you're busy, and we look forward to seeing you on the 20th.
Thank you.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.